Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and of course a touch of crystal ball gazing. Today is March 10th, Monday, March 10th, 2025. Today's episode begins with the S&P 500. I wanted to bring up 8.6% down from the peak and appears to be falling quickly. Some technicians are saying that this is a bounce level where we are today and we could see a bounce. Others are saying that this is when the machines are kicking in, the AI traders, and that they're just going to keep selling down and down. I don't really know. All I know is that the market is clearly in panic mode as it stands today. The pricing of options contracts, the VIX, clearly in an uptrend with a solid green candle today. Just from these candles, doesn't look like the market is done being fearful yet, not to my eye. This could be a peak in the VIX, and it also might continue higher. We are getting some mixed signals from various markets. We'll get into the charts in a moment, but next thing on the agenda, just wanted to mention CPI and PPI come out Wednesday and Thursday. These are very important inflation gauges. And then before we get to the charts, the community topics, someone noted in one of the comments recently the U6 unemployment rate. So thank you for bringing this up. This isn't something that I check regularly, but is very important. I hear it referenced all the time. Trading Economics has a great explanation of it. It basically adds marginally attached workers and workers forced to work part-time for economic reasons to the regular unemployed number. So it adjusts the regular, that 4.0% number that came out recently. It adjusts it so that people that have like temporarily stopped looking for work because they're just like, I give up. It also adds people that are working part-time even though they want to work full-time. And so it changes the numbers a bit. And when you look at it on a chart, it's a little scary coming from the Fred, total unemployed. So U6RATE, all in caps, is the series on this. I'm going to note that we never really see this go up as much as it has from the bottom, except for during like recessions or right before major recessions. Again, this data only goes back to 1994, but I tried to find a spot where we rose as much as we have recently, you know, from a low in 2023 of 6.6, I think is the low, to 8 now. And so that's 1.4 higher. That it never goes up that high unless we're headed into a recession. And this is, the February report spiking higher. So just another sign that, you know, the economic slowdown is like, we're facing the storm here. And I don't know. I mean, it could take a little longer than I expect still. I mean, Mr. Market's a crazy guy. He might recover back up to 6,100. He might get to 7,000 before things really fall apart. You know, anything can really happen. But, you know, I'm not going to participate in bubbles or things that seem ridiculous for their price compared to their valuation. And, you know, stocks have cooled off a bit here. You know, this correction we've seen in the S&P 500 and the NASDAQ and all these mega cap companies, it's a little bit of like a tension release is the way that I'm interpreting it, even though a lot of people probably see it as the world falling apart. This is like a little bit of reversion, a little bit going a little towards normalcy. And I think we're not anywhere near what is normal in terms of price of securities right now. I still think we're in a bubble. And again, bubbles can keep getting bigger. This might be it popping. I don't know. Anyway, thank you again for the comment. I was kind of curious from the community what you guys think of my new profile pic and my new banner at the top of my channel. If you guys like it or any suggestions for it. And as always, thanks for watching, subscribing, and all of the very generous support. Before we get to the charts, daily reminders, watch Macro Update 211 to hear me explain my overall macro views. Few little updates. The PE dropped, you know, from 30, 29 to 28, and the CAPE ratio is only at 35. I mean, this is still like historically very dangerously nosebleed, very, very, very dangerously expensive, with, the dividend rate still only being 1.3%, a historic low for the dividend of the S&P 500. Junk bond credit spreads, although have, widening recently, we're still around 3% there, which is still really tight. And everything else is basically the same. Also, watch Portfolio Update 21125 to hear me read through my crystal ball readings and explain my own portfolio. On to the rest of the charts for today. I wanted to bring up the 10-year Treasury note yield dropping today. I am going to note that this is on the same day gold actually dropped a little. Right, so this red candle is actually today. Again, the UTC time, it gets a new candle there. So gold dropping by 0.7%, all while, stocks are dropping. And, gold's supposed to be a run to safety, and yet, it's not always. Granted, there are traders out there, including Gareth Soloway, that think that, because gold has gotten so overextended in price that, if people are looking to find money to put into stocks and see them as, potential buying opportunity, it makes sense to rotate a little bit out of gold. But my take on it is that when you see gold dropping at the same time as bonds getting a bid, this is no longer the story that, we're worried about inflation being the main concern, the main driver. And instead, a worry that, this is actually like more looking like disinflationary, deflationary action, along with the stock market dropping. As always, the only thing worth looking at regarding what the market is pricing inflation to be at is the 10-year break inflation rate, and it is absolutely collapsing down to only 2.3% today, and just going down and down. It will be very interesting to see how CPI and PPI later this week affect all of this. The CME Fed Watch tool, the probabilities of rate cuts, where are the Fed funds going to be? This is the Fed futures. The Fed funds futures. And we very recently moved, it looks like today we moved to May to be basically 50-50 for cut or no cut. Previously, it was solidly not until June. So the cuts are moving closer as expected, especially as market volatility is happening. The market's kind of thinking, oh, the Fed's going to step in and be like, okay, we can lower rates now because, the market's not as high. Remember, a lot of wealth effect is stripped out of the market when Mr. Market's price is going down. And, the Fed does use the stock market as a gauge to make their decisions. They say it's not one of the main things, but they certainly do use it. I also want to remind everybody that, those preliminary GDP reports for the first quarter of 2025 being negative 1.5%. I mean, 2 back-to-back quarters of negative GDP is the official, recession. And so that's weighing in on here. But yeah, we didn't see this change in the Fed funds rate until today. The Fed funds futures until today. Crude oil, I've been saying if we close and confirm below the $65 level, we're headed to $35 a barrel in oil. Because of some trend lines going back all the way to 2021. It looks like that's the key level that everybody's kind of watching. As it stands, oil is looking pretty weak. Right now it's at $65.71. I would expect a bounce at the $65 level, maybe even a decent substantial bounce, maybe all the way back up to around 70 or so before rolling back over. It's hard to say exactly what's gonna be happening, but I suspect with my crystal ball and all that this may be going down faster and sooner than anybody else thinks. One metric that I'm keeping an eye on that's surprising me is, well, while everything else in Mr. Market is falling apart here, copper is just, eh, he's not convinced yet. Very interesting seeing copper basically go sideways since the beginning of February while everything else is just going into complete chaos mode. Again, like it's more normal to see gold stay a little steady than copper because copper is an industrial metal, and if the economy is really going to slow down and things are going to get bad, you would expect Dr. Copper to lower in price, and he hasn't yet. So, um, you know, he's a little more patient maybe than some of the other markets. Maybe he will eventually go down if he's convinced, but he's not convinced yet. Last chart of the day I want to bring up is Bitcoin. It seems like we're headed to that $75,000 level that marks an area that a lot of professional technicians are looking for to be a bounce or a buyable spot. It might be good to get into Bitcoin a little bit, maybe at that $75,000 level. Although with markets falling apart here, I hope I can find some time to comb through some things to maybe find some more better, safer things to start getting into while there's amidst the chaos. So that's all for today's show. That's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.